adams-financial.org.
The following program is sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
Yeah, it's Friday afternoon, and we're going to be talking about money. The fight over the fiduciary standard. You know, most people don't understand there's a difference between fiduciaries and non-fiduciaries. For financial advisors, it's become a very big fight in Washington, D.C., and it was joined this week, or this last week, by an arbitration group, a group of arbitration attorneys who said that what is said in public, in the public ads, is not at all what's being said in the non-private arbitrations. They're comparing the ads to used car ads. We're going to be talking more about that as we come along. There's a lot more to be said about that. And there was a piece in the Wall Street Journal, a blog or an article by Jason Zweig, who said that now we've come through this period of time since March of 2009 where the market has done extremely well, that based on a couple different models, the Schiller model and the dividend model, that people should expect 2% on their stocks, or even 3%, but that's the most we should receive. I completely disagree with that. I think that they're missing a whole lot, and I'm going to talk about that. But it seems like it's a race to the bottom. A couple weeks ago, somebody said 3.5% was the most. 4 or 5 weeks ago, I talked about an article that came out in Investment News that said 4% was a good return in 2014, even though the market was up 13.7. You know, it seems like there's a race to the bottom to see who can forecast the lowest rates of return. What a scary thing for investors. I disagree with that, and we're going to be talking about that later in the program. My guest today has got a lot of things to say. He's been around Seattle for a long time. He's seen a lot of things. He remembers when KKOL was KOL. It was a rock music station. We're going to come back, talk to him not about music. We're going to be talking about his business, so don't go away. But sometimes there's something that you may have questions about, or you may want to interact. We have a thing called Reach. You can sign up for a free app and answer questions. The questions this week is, where do you think oil prices are going to be in a year? We're going to give you a couple choices. Go sign up for the app and answer the question. See where you think oil prices are going to be. So for the last 5 years, I want to talk about this whole thing about the fiduciary. I've been talking about it for a long time. The New York City Comptroller proposed language this past week, proposed language that should be used by non-fiduciary financial advisors. Now these, to give you a little background, financial advisors come out of two different acts. The Securities and Exchange Act of 1932 established broker-dealers. And those financial advisors who work for broker-dealers used to be called stockbrokers. And that's what they really were. They moved stocks, they moved bonds. You know, after the crash of 1987, because people began to think about stockbrokers as being not a very romantic kind of profession, they changed the name to financial advisors. You know, gave them an upgrade. Kind of remember when we used to call homeless people hobos, but we changed that language as well. That was the idea, financial advisors. And that was supposed to be an elevation. And most people look at their financial advisors as somebody who's trusted. That's a financial advisor that falls under the Securities and Exchange Act of 1932. They're registered representatives is what they are. And they fall under what's called a suitability standard. At the same time, you have financial advisors who fall under the Investment Company Act of 1940. And those financial advisors fall under a fiduciary standard. And a fiduciary standard says every decision you make has to be in the best interest of the client. So it's been a heated argument because the very large firms are the ones who have registered representatives that they call financial advisors, and those registered representatives are not fiduciaries, but they have to make sure that things are suitable for their clients. And there's a difference. The New York City Comptroller proposed language for those representatives that when they meet with clients or potential clients, they should say, and I quote, "I am not a fiduciary. Therefore, I'm not required to act in your best interest, and am allowed to recommend investments that may earn higher fees for me or my company, even if those investments may not have the best combination of fees, risk, and expected returns for you, the client." That's what he proposed to the state legislature, that they make that language part of what a financial advisor who falls under the Securities and Exchange Act of 1932, that's what he recommended they have to say to clients. Well, of course, that caused a storm. But it brings to mind what the real case this is. 90 to 95% of the time, financial advisors who are registered representatives truly do have the client's best interest in mind. And that client's best interest, 90 or 95% of the time, lines up with the company's best interest. But it's not always so. Sometimes the companies have their interest, which is conflicting with the client. Sometimes the company wants to push certain products, or they want the advisor to achieve production goals. And you do have production goals as a financial advisor working for the large company. They rate that, and you get rewarded on how many dollars of commissions, how many dollars of revenues you bring in. You'd expect that anyway. If you're running a business, you want to see the revenues come in. So all a financial advisor at a large company has to do is find an investment that's suitable. It may pay a higher commission. It may pay a higher fee. There may be hidden fees that flow back to the company. There may be hidden fees that flow back to the advisor. But that's what is happening in this whole arena. When Dodd-Frank was passed in 2010, following the Great Recession, the idea was to put together a fiduciary standard that would apply to all financial advisors. Pretty simple. Make every decision in the best interest of the client. But it was a big argument during the time before Dodd-Frank passed. And once Dodd-Frank passed, they passed and kicked the can down the road and said they wanted the Securities and Exchange Commission to come up with a fiduciary definition that would fit all financial advisors. Well, here we are 5 years later, and it hasn't happened because the big firms are pushing back. The big firms are saying they fall under FINRA, the financial investment arm that oversees the registered representatives, and they say that they've got a whole lot of rules and regulations, and they do. I fell under FINRA for most of my career, and I'm telling you, they have rules that one rule after another, after another, after another. They have to have it balanced. You can't say good morning. You have to say, it could be a good morning, and it may not be a good morning. It depends upon where you live and what you're doing. You know, with a financial advisor who falls under the Investment Company Act of 1940, a fiduciary, every single decision has to be made in the best interest of the client. You see it in 401ks. You see it in pension plans, where not every decision is made in the best interest of the client. Very often, they're made in the best interest of the company. The Department of Labor did a study, and they showed that up to 17 different fees were being charged to 401ks. 17 different fees, and a lot of those were hidden. There were kickbacks to the broker. There were kickbacks to the firm. There were kickbacks to the mutual fund company. All those are being charged, and nothing's showing up. All of it was hidden. So the Department of Labor has come out recently saying they're going to do a fiduciary standard. And that got impetus because President Obama wrote a letter to the Department of Labor and said, I want you to pass a fiduciary standard because studies are showing that it's costing participants in those plans $17 billion a year. Whether it's 17, whether it's 15, whether it's 25, it's a very, very big number. And it's really there. And so, of course, there's a lot of pushback by Wall Street. Those dollars, a good portion, are going to Wall Street, to the firms and to the brokers who work for those firms. That's where things are going. And so there's a big pushback. So when you have a language like proposed, I am not a fiduciary, therefore I'm not required to act in your best interest, and I'm allowed to recommend investments that may earn higher fees for me or my firm, even if those investments may not have the best combination of fees, risk, and expected return for you, it creates a lot of controversy. We're going to come back and talk to it back and finish this up right after the break. Don't go away. Got more to say. And you want to hear my guest? You also want to hear my comments about 2% returns. Awful. Terrible. But don't go away. I'll be right back.
Stay tuned. About Money returns in a moment with your host, Mike Adams, here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
You know, Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our clients' interests first in all portfolio decisions.
If you're looking for a home for your seven-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com/signs for details.
About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I've been talking about the whole argument over the fiduciary standard, and there's been a lot of pushback. But one of the other things that came up this last week was the Public Investors Arbitration Bar Association wrote a call for action. They said that 9 firms, and they named Merrill and Fidelity, Ameriprise, Morgan Stanley, Schwab, UBS, and Wells Fargo, their ads are placed and make you sound, or make their investment advisors sound like trusted fiduciaries, that they always made decisions in the best interest of their client. But they said that once they got into non-public arbitration, that they completely refused that. And he gave an example of Merrill Lynch, for example, saying that Merrill Lynch makes the advertisement, and it's a quote, "It's time for a financial strategy that puts your needs and priorities front and center." That's the Merrill ad. Said once you get into arbitration, they say we're not held to a fiduciary standard. We're held to just a suitability standard. Fidelity Investments appeals to investors with these words, is what the arbitration panel said: acting in good faith and taking pride in getting things just right, the personal commitment each of us makes to go the extra mile for our customers and put their interests before our own is a big part of what has always made Fidelity a special place to work and do business. That is the advertisement. But when they get behind closed doors in a non-public situation, You say, we're not fiduciaries. We don't have to put our customers' interest ahead of ours. All we have to do is make sure it's suitable. Joseph Pfeiffer, the president of the Public Investor Arbitration Bar Association, says that he's handled over 500 cases. He's handled cases where somebody's lost 75% because of bad advice, but the person was invested in suitable investments. They lost over 75%. He's had cases where people have lost so much money they had to move in with their children, or they had to relocate from their house to a trailer in a friend's backyard. Said he's seen devastating results from the same companies that advertise that they put their clients' best interest first, and yet when it gets to arbitration, they fall back on the fact it only has to be suitable. It doesn't have to be in their best interest. You know, if the fees are higher, if the investments are not achieving the type of return that they're supposed to receive, it's suitable for the client, so it's not our responsibility. They say, and this is the organization that said, the ads they're producing are just like used car ads. Trust us. Trust us. That's what's going on. That's what's going on, and maybe through this whole process, the Department of Labor will come out with a fiduciary standard for all financial advisors. They will have to be fiduciaries for the 401ks and for pension plans. And the Securities and Exchange Commission, Mary Jo White, the head of the SEC, said that she is going to propose a fiduciary standard. So maybe we're finally going to get there. It's been 5 years, a lot of pushback, but maybe it's going to happen. Anyway, I want to switch things, and I want you to meet my guest today. He's the president of Kovich Williams. We're going to be talking to Mason Williams.
Hello, Mike.
Welcome to the program.
Thank you.
So why don't we start with your background? Tell us.
Well, I grew up in Ballard, went to Ballard High School, went to the University of Washington for a year, and started working at the commercial fuel dock while I was in high school, actually, in 1966, part-time, after school, weekends, that kind of stuff. So,
I want to go back and ask you where were you born?
At Virginia Mason Hospital. That's partially how I got my name Mason.
And if you'd been a girl?
Virginia, I'm sure.
I think that's a great story.
Well, my mom's doctor was Dr. Mason, so I don't know. He had some nice gloves, I guess.
Okay. So let's talk about Kovich Williams.
Well,
tell us about
Mr. Kovich, who I worked for. He got sick I think in 1969, if I remember right, and asked me to drop out of college my second year, so which I did while he was in the hospital, and he recovered, and then he just kind of took me under his wing and kind of groomed me to take over the place. He was approaching 65 at the time, but the illness that he had really knocked him down, and he just couldn't do the physical labor anymore. Meanwhile, I married my high school sweetheart, and we had a child in 1974. He finally decided he was going to retire, and
the child did?
Yeah, no, Mr. Kovich, and so he one day announced, unbeknownst to Linda or myself, that he was going to make me a partner in the business. And as it turned out, because the illness kept creeping back on him, in 1970, late in 74, he said, "I've changed my mind. I want you to buy me out." So January 1st, 1975, I became the owner of Kovich Williams.
So,
yeah. And
you've been doing that for 40 years.
40. It's going on 41 now, Mike.
Wow.
Yeah. And I've been there going on almost 50. Another year I'll be 50 years. So
see how time flies when you're having fun, huh?
I've never looked back, I'll tell you that.
So tell us what Kovich Williams does.
We're an oil distributor, basically Chevron products. I got to get that one in. And we also sell filters, commercial filters, wholesale filters. And so lubes, diesel fuels, gasolines, avgas, jet fuel, you name it. If it's a hydrocarbon, we sell it. Or spill it, whichever comes first.
So in 75, when you bought the firm,
Yeah.
you were supplying what industry?
Basically, the commercial fishing industry was number one, and the tugboat industry. So those are our two main customer bases that we have always gone for. And so we had like Foss Launch and Tug is just up the canal from us. And so these large tugboat companies, and the tugboats take a lot of fuel.
Yeah.
Fishing vessels are seasonal, as we all know, but in 1975, that was pretty much the start of the big push for crab fishing. And so we had a huge amount of new vessels being built. I mean, every shipyard in the United States was basically building crab boats from 75 on till probably late 80s. And so I got into this right at, it's not what you know, it's who you know, and timing's right, things like that. And I got in at the right time, and so we had a huge boom in the industry, in the fishing industry.
But then that tailed off at one time.
Yeah, in the late 80s, the Magnuson Act was passed, and then the late 80s, the crab industry was getting a little thin, and we had overpopulated the crab industry. So we had, I think, at one point 365 crab boats fishing in the Bering Sea, compared to today, which is probably somewhere around 80 normally for a crab season. So there's a considerable decrease in those vessels.
So there's a decrease in the number. Has there been an increase in the size?
No, the vessels are the same. The same vessels are still fishing. But the decrease that I saw coming in the early 90s, and we decided to go in different directions with the company for more commercial and industrial accounts, land-based accounts, things that we've never approached before. So we started diversing in 1990 to keep our volumes up and keep the company viable.
And so what sort of additional industries are you supplying right now?
Well, rail yards, automotive dealerships. Still, the fishing industry and the tugboat industry are very strong. Don't get me wrong. And just anything that requires petroleum products, which is pretty much everything.
Everything.
Yeah.
It really is broad.
Yes.
All the way around.
Yeah. So you don't have to look that far to find new accounts.
So the gasoline that comes in, or the oil products that come in, how did they come down the pipeline?
Yes, we have 4, or actually 5 refineries in the state, but 4 of them are on the pipeline, Anacortes and Ferndale. They come down the pipeline to Seattle when the pipeline's working. Everybody, that's another thing that's kind of going south in this country is pipelines. They were all built in the 50s. Mm-hmm. Do the math. They're getting old. They need to be replaced, and nobody wants a pipeline in their backyard. Yeah. But they all want gasoline, diesel fuel. So the product comes down, and then we have in Seattle, our large tank farms are on Harbor Island.
Mm-hmm.
So, and the city's made it so we can't get to Harbor Island anymore, but we're still trying.
So when you talk about different gasolines, you have the different service stations and so on. But if all the fuel is coming down the same pipeline, what distinguishes one company from the other?
Additives. The amount of additives they put in, the type of additives. So if you want to keep your car running well, then having additives in the gasoline is a good thing.
Okay.
And keeps the injection systems clean, keeps your injectors clean. And that's very important.
So we're going to come back and talk about that right after this commercial break. We're going to talk about some other things to do with the oil industry. So don't go away. We've got a lot to say, and I want to talk about this 2% thing, too. So don't go away. Be right back after this commercial break.
About Money. We'll resume in a moment with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I'm here with Mason Williams of Kovich Williams, and we just started to talk about the gasoline coming down the pipeline and the additives that are added. Now, you represent Chevron, so I would assume that those additives are pretty special.
Chevron's had their own additive F310 and gasoline for a million years. I mean, it's nothing new. Everybody knows it. They've advertised it, and then they came out with a Techron additive here about 15 years ago, and it's done a very good job. Shell's got a very good additive, and they do a good job with their products too. So it's a lot of there's a lot of good additives, but I've always said you get what you pay for. So if you're paying 20 or 30 cents a gallon less for your gasoline, you're probably not getting a lot of additives in your gasoline. You might not even be getting 87 octane. Who knows? But it's you got to look at what you're getting, and if your car runs fine on cheap gasoline, well, why not burn it?
But if your car doesn't run so fine on,
try something else.
So let's talk about something that happened a number of years ago, the spill of the Exxon Valdez. But before we get to that, I want to talk, you related at one time a story about herring and the great market that there was for herrings. So why don't you tell us?
Well, the Japanese and the Russians love caviar, and so our herring business back in the 80s was just absolutely booming, and the prices were high, and which is not the case now. But so there was probably an average of 15 to 20,000 metric tons that came out of 15,000 metric tons every year came out of Prince William Sound, minimum, and that was the except for Togiak, that was the biggest herring season that we had every year, and that herring has, because of the Valdez, actually vanished. So it is it creates a cavity of sorts that you can't replace in the industry. That was a big money maker for many vessels, trust me.
So when we talk about that was a long time ago. And how did the spill affect the herring? What?
Well, it kills all the kelp, and then the herring show up, and they don't have any place to spawn. And so the kelp is, I think, coming back, and the run will come back probably, hopefully, within another 10 years. They'll start seeing some good signs of herring again in Prince William Sound, and things will get back to normal. But what are we talking here? 27 years?
Yeah.
Yeah. So it doesn't happen overnight. It takes a while for nature to clean itself up.
You know, and you think about what happened there and the number of years it's affected us. It'll be, 40 years before it's
probably I would have thought the product, the herring, would have been back and thriving again in Prince William Sound, but it's just not there.
And then we talk about the spill that happened in the Gulf oil.
That was very serious, and I don't know where British Petroleum is going to end up here with the liability there, but they probably are close to bankruptcy, and the lawsuits are stacking up, and it's hard to say. They might have to sell, and there might be, British Petroleum is the largest oil company in the world, and for somebody like that to start looking at their whole card and thinking they better shut the door, that's pretty serious.
But it's also serious for the environment in that area, and the fishing and what's going on that way.
Yeah, I'm not that familiar with the Gulf and the fish runs and everything. I mean, obviously, it's very serious. There's no doubt about it. So I don't know how it's what its damages, but I'm sure that there's going to be long-term damages there, just like they were in Prince William Sound.
Yeah. It's something that it's sad when it happens, and yet it's something that we need the oil as well.
Yeah. There's damned if you do, damned if you don't.
So your outlook on the oil market these days?
Well, I kind of like the lower prices. Industry loves the lower prices. The fishing industry is very happy getting diesel fuel at low costs compared to what they were 3-4 years ago. It's 50% actually.
Yeah.
We're less than 50% than we were 3 years ago. So that helps the bottom line on any business because that's their number one expense is fuel.
So are you seeing a pickup in the amount of fuel that's consumed now?
A lot of vessels that didn't operate, that were marginal operations at $4.50 a gallon are back operating now. Yeah.
So I wanted to talk about just one more thing. When you bought the business, there were other distributors as well. And today there's what? There's 2 of you that are left?
Yeah, there was 7 commercial fuel docks inside the government locks in Lake Union. And now we're down to 2. Good friend of mine owns he's my competitor, but we're also good friends, and he's a great guy, and it's a family-owned business, and he's done quite well for the last 35 years also.
Mm-hmm. So what was it that gave you the competitive advantage?
We had larger tank farms than our other competitors that are no longer there now, and because of that, we had a little more property. We had tank farms, and so we were able to take care of the larger vessels in one clean single operation, where some of the other fuel docks just didn't have the volume.
Yeah. Well, you've done very, very well for yourself since 1975, 50 years in the business.
I'm still washing the floors and doing the dishes, so it's good.
I understand. I do the same thing at my company. So if someone wanted to get a hold of you, how would they do that?
Well, normally you could do it by email, or you could pick up a telephone if people still know how to make a phone call. But email seems to be the way, or Facebook seems to be the way everybody wants to do business now.
And your email?
Mason@kovichwilliams.com.
And the phone number?
206-784-0171.
That's great.
Right.
Thanks for being on the program, Mason.
Thank you, Mike, for having me.
Very
I enjoyed
interesting story.
All right.
So I want to shift and talk about, actually I want to back up a second and talk about the first summer job I had. The first professional summer job. I worked in a lumber mill. I worked moving furniture. I did some of those things. But the first professional job I had was in the Operations Research Department of Pacific Gas and Electric in San Francisco. First time. And back in those days, and today too, if you have a utility and they're trying to forecast their power consumption, that's a really important thing for a utility to do, because if you build too late, you go into a brownout. If you build too soon, you're wasting money for that investment. So forecasting power was a very big deal. And up until the time of the advent of the computers, what they'd do is they'd sit down, take out the book from last year, count the same number of dividers, and put it into the new book, and that would be the forecast. But they wanted to upgrade, and they put in the operations research department to begin to look at it on a computerized basis. And what we did, we looked at moving averages, but we also looked at regression analysis. And this, when you hear about correlations, that's all comes out of regression, linear regression, multiple regression. It's all saying one variable will determine what another does. If the temperature goes up in a day, you're going to consume more air conditioning, for example. That's the temperature causes air conditioning to go up. So we wanted to see what affected electrical consumption in Northern California. At that time, it was a utility for only Northern California. So we threw all sorts of variables into the mix, everything we could think of. And we tried to see linearly what was the greatest effect on electrical power consumption for Northern California. So what would you think? What would you think we found? You know, you can take any variable, but what do you think we found had a 97% correlation? It was almost a perfect correlation. The more it increased, the more electrical power increased. The more it declined, the more less power you used. Well, of all the variables we found that summer that I was in that department, the number one variable that correlated the very best with power consumption was the number of prisoners on Alcatraz. You know, if that had been a true correlation, today there would be zero power consumption in Northern California. Not that that isn't something some people would want, but that's another story. I'm going to come back after the commercial break and explain what went wrong and why that was wrong and how that applies to what we're looking at in the markets. So don't go away. We've got a commercial break coming up, and I'll be back after that commercial break to talk about why that didn't make any sense.
More about money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
You know, Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our clients' interests first in all portfolio decisions.
If you're looking for a home for your seven-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
Money is everything.
We're back with more about money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So I started talking about the summer job I had, and I worked in the operations research group, Pacific Gas and Electric, developing forecasting models for power consumption in Northern California. And we found that the very best correlation was with the number of prisoners on Alcatraz. Now, if that was true today, there'd be no electrical consumption. So what I learned from that whole thing, I was young, I was bright-eyed at the time, thought, it was really a confusing time. But what I realized is that there has to be a causal effect. Some of the same things people talk about are, why does ice cream consumption go up in the summertime and go down in the wintertime? Because there's a cause effect on the whole thing. That was the problem with the correlation we found for electrical power consumption. And actually, we didn't ever use that. So that brings me to this whole idea and talking about this column that was written in the Wall Street Journal. Jason Zweig wrote it, and he based it on Professor Robert Shiller. Now, Shiller is the guy, the economist, that along with the other economists have developed a housing price, the Case-Shiller model. And the two of them were able to predict that housing prices were going to crumble down and whatever. They were pretty accurate in forecasting what happened with housing prices in the 2006, 2007, 2008 time period. And as housing prices have recovered, they've had a pretty good model. But they've also talked about stocks, and they went back and they take the previous 10 years and the earnings for the previous 10 years, and they look at that in terms of the price-earnings ratio for the previous 10 years and say, that's a forecaster for what's going to happen with stocks for the next 5 or 10 years. So they're looking back at a time period today, a time period that covers from 2005 to 2014. The beginning of 2005 to 14. If you're a mathematician, you realize that's 10 full years. It's that 10-year time period says that the price-earnings ratio during that time was 27, and that the average going back all the way to 1871, the average has been 16. So that if you apply that logic and that reasoning, it says that stocks today are overpriced by over 50%. The market should be down from 18,000 to 12,000. If that logic is right, the Dow should be down 6,000 points from where it is today. Or it's going to take a long time for the actual price-earnings ratio to catch up with where the stock market is today. The problem is the data goes back during a very difficult time period. It goes back through the Great Recession when companies were not making a lot of money. And so when you average a company that's losing money in 2008 with a company that's making some money in 2014, the numbers don't look so hot because you're taking a very difficult time back then with a good time this year. When you look at the stock market is looking forward, not looking in reverse. It's looking at what companies are going to do, not what they have done. So there's a fault with the whole logic and the whole reasoning behind that. And during normal times, that relationship may very well hold. But right now, to say that the stock market is overvalued by 50% doesn't make sense. Logically, it tells you that that's not true. Another method is to take the total dividends and divide it by the current stock price. This is something that shows that stocks now should, for the next 8 or 10 years, get about a return of 3.5%. But again, this is a methodology that goes back to the 1930s. And we're seeing the turnover in companies happen and leadership happening much faster today than it did during the 1940s and the 1950s and the 1960s. You look at the companies which have grown and the speed at which they've grown. You look at Microsoft is now 40 years old, but it was added to the Dow about 10 years ago when it was 30 and when it wasn't paying a dividend. You look at Intel and some of the other companies. During that early growth phase, they're not paying dividends, and yet they're becoming a significant player in the market. Microsoft in the 1990s and into the early 2000s was a significant player. So was Intel. So was Apple. So were those companies that have been added to the Dow. They weren't paying much in dividends if they were paying anything in dividends. Where you go back to 1966, where you had companies like U.S. Steel and Bethlehem Steel, Anaconda Copper, you had those kind of companies which were slow, plotters, they paid a lot in dividends. So once again, the data has changed. And looking forward, it just doesn't look right. I've been talking now since 2010 about Dow 100,000. And I may be underpricing the Dow. But if you look at what's going on in the Case-Shiller model, it's a good, bad, and ugly situation. The ugly, 2008, it was a horrible market, down 37%. The bad was 2007, where the market actually went up, but then began to crater down, and 2009, where until March, the market reached a low of just between 6,600, a little plus. But the good years have been 2009 to 2015. Well, when you take the whole average, and that's the Shiller approach, it doesn't look so good. It looks like it favors the bad, not the good. It doesn't favor the ugly. It doesn't favor the good. You know that you've lived through that period of time. You know what happened. And you know by looking in reverse that it's not going to be a forecast of what's going forward. I'm a believer that the stock market is headed upward. I've talked a number of times about the super cycle, and I believe we're into a super cycle. We're seeing that happen. We're seeing companies of tremendous growth, seeing companies grow very fast, and the leadership of companies change dramatically. I think we're going to continue to see that. Just a quick overview, we saw an increase from 1941 to 1966 of the Dow increasing from 100 to 1,000. And then from 66 to 82, it stayed essentially at 1,000. It went down a few times, but came back to 1,000. From 82 to 2000, it went from 1,000 to 14,000. And then from 2000 to 2009, it stood. You could have gone away and thought that the market didn't move at all because the market was ended close in 2009 to where it started in 2000. But what we've seen in the last few years is a market and a secular bull market that's on the move. The conditions are right. We're seeing companies move. We're seeing the changes that are happening in the economy. We're seeing the changes that are happening in the world. The supercycle says the next supercycle, the first supercycle was from 1870 to 1913. The second supercycle from 1945 to 1970. And the final supercycle began in 2009. It's going to be driven by what's happening worldwide. We think that it's going to be a very good time. But more about that next week. I will be back and give you greater detail about what's going on. Join me then. And until then, have a very happy Easter, and my best to you.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Friday afternoon at 3 for more About Money with Mike Adams, here on Money Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's Adams Financial Concepts.